The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A rate cut by the Fed becomes a green light for the market. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And boy, we have a lot to talk about. Let's walk over to this board because the S&P 500 up by 0.6% right now. That would be a new record. Big tech also getting out there. The Nasdaq 100 higher by more than 1%. It's the small caps where all of the action is right now. The Russell 2000 higher by 2.4%, on track to close at its first all-time high since November 2021. It has certainly been a while. This all coming out of that meeting that we got from the Federal Reserve yesterday, cutting by 25 basis points, signaling more to come. But interestingly, Romaine, sent yields a little bit higher. The 10-year Treasury yield higher by about one and a half basis points.
Yeah, and we talk about some of the price action today. Remember, it was just yesterday where the benchmark S&P posted its second smallest swing on a Fed day in at least 2 years. But what a difference a day makes. The richly valued tech sector was the worst performer yesterday, flipping today to be the best performer. Equity bulls digesting the FOMC decision and waking up today firm in their belief that rate cuts will keep powering stocks higher.
In my opinion, this is really going to turbocharge this tech rally. And it's not just about Mag 7.
Yeah.
It's about second, third, fourth derivatives.
Yeah.
I think tech stocks could be up another 10% between now and the rest of the year.
Chip stocks actually lapping everybody today. The Philadelphia Semiconductor Index outpacing the S&P by the most since May. Micron up a 12th straight day, longest winning streak on record. Lam Research on its hottest streak since 2019. And how about this? Intel here on the anniversary of the Traitorous 8, jumping more than 20% today. A surge of this magnitude last seen all the way back in 1987. Meanwhile, the Russell 2000, home to some of the riskiest and most indebted companies out there, shining bright, outperforming the S&P by a factor of 2 to 1, now on track to post its first all-time high since 2021, ending the longest stretch without a record since the dot-com bust. But all the market euphoria out there could be a bit counterproductive, as ironically, it could actually prompt the Fed to hold off on cutting rates again anytime soon. How does this work, Katie?
Financial conditions, you got to keep your eye on them. But let's talk about where the market thinks we're going. We finally got that 25 basis point cut yesterday. And as far as where we go from here, you can see Fed funds hanging out around 4.25% right now. But the terminal rate that this market is pricing in closer to 3%. So we would need 125 basis points of easing here to get that. We know that we have a few cuts priced in already. I thought this was interesting, though, that the terminal rate priced at 3%, because you think about what we heard yesterday from FOMC participants, their guess as to where the neutral rate, the long run neutral rate is 3%. So that seems to be the magic number here, Romaine.
All right, as we kick you off to the close, let's get some insights out of Ed Yardeni, President and Chief Investment Strategist at Yardeni Research. And Ed, I think yesterday's decision was certainly expected. I am curious, when you look at the market reaction, are they reacting to the rate cut yesterday, or the prospect that we're basically at the start of a prolonged rate cutting cycle?
The answer is yes. I think it's both. Clearly, the rate cut yesterday was widely anticipated, and maybe as a result, when it happened, the markets didn't really respond much at all. But very often it's the next day after what the Fed does that you get the reaction. And so the positive reaction makes sense that the market might be anticipating further rate cuts. Also today, we had some good news on the economy. I mean, we're kind of getting the best of all worlds. We're getting somewhat easier interest rates, financial conditions, and at the same time, we're getting some good news on the economy. So that would be good for earnings. And it's all about PE times Z. The earnings outlook remains very strong, and the valuation multiple is only helped by lower interest rates.
I am curious, though, separating out kind of what we're seeing maybe in stocks and the potential impact, positive impact to the bottom lines, and what we're seeing in the economy. Yes, encouraging economic data, but you still had Jay Powell yesterday articulating this idea that when it comes to the labor market and, for that matter, inflation, we still got a ways to go to get it back to, I guess, what the Fed would be comfortable with.
Well, you know, he's kind of trying to have it both ways. He wants to be non-committal about what the Fed's going to do next. He wants to say everything's on the table and everything's off the table. It's all going to depend, you know, what's on the table is going to depend on the data. And what we do know for sure is that inflation is not at 2% yet. There's still an overshoot there. Maybe they're going to conclude that they can't do much to get it much lower. And so on a de facto basis, 3% will become the new inflation target. I wrote about that in the Financial Times today, that the Fed's kind of being challenged by the dual mandate. It's hard to do both, keep employment at full and inflation down.
Well, just to draw that out a little bit. So, okay, you make the case why it might be the time to repeal that dual mandate, but what should they actually abandon here? What is the more pressing issue that the Fed should be concerned with?
Well, in my opinion, it should always be inflation, and even more importantly than that, financial stability. The Federal Reserve at the end of 1939 was established to a large extent to help maintain financial stability, to avoid financial crisis. And when crisis hit, they were supposed to do the central function of a central bank, which is to provide liquidity and get us out of that kind of financial crisis. But I think of the two other goals, inflation and unemployment, I think it's been said often by Fed Chair Powell that it's hard to get a stable economy with low unemployment if you have an inflation problem. So first and foremost of the two, I think you want to get inflation down. So you got three goals: financial stability, low inflation, and low unemployment. And I think that's sort of the priority of the goals.
And Ed, I do want to talk a little bit about the cross-asset picture and focus on the bond market specifically, because right now the 10-year yield higher by about 1 basis point. It was higher. We were looking at 4.12 on the 10-year a little bit earlier this morning. One of the fears out there is that we're going to see a repeat of last year, that you had the Fed deliver that basis point cut, and then you actually had the long end take off.
Correct.
Do you see that maybe playing out this time around?
I think it's a realistic possibility. As you said, last year, September to December, the Fed cut the Fed funds rate by 100 basis points, and the bond yield went up 100 basis points. Mortgage rates went up 100 basis points. So the Fed easing really didn't help very much if they were trying to get interest rates down across the board. And I think it's a possibility that the same thing happens now. I mean, the deficit issue is going to come back into the fore as Republicans and Democrats start fighting over the potential of closing the government. And the Democrats want to get an increase in spending, reversing some of the cuts that the Republicans took out of their favorite programs. So the deficit issue isn't gone. The potential for a debt crisis is still there. And I think that's why we're not seeing the bond yield do particularly well with the Fed cutting rates. On expectations, it got just below 4%. Now we're back at 4.1%.
Well, this raises a lot of questions about just the effectiveness of what Jay Powell and the Fed, or whoever's going to be leading the Fed in 2026, can do. I mean, even these first few months of this year, the idea of Jay Powell back in January talking about wanting to wait and see the impact of trade policies and other policies out of the Trump administration, it was kind of an acknowledgement. And I think you kind of touched on this idea in general in your column in the Financial Times, that there are just a lot of other forces right now in our economy that are, if not immune to monetary policy, certainly not something that monetary policy, at least in terms of raising and lowering rates, can in and of itself address.
Well, the whole point of lowering interest rates here is to stimulate the demand for goods and services, which in turn should stimulate demand for labor. But a lot of the problems in the labor market seems to be supply related. So we had basically a drop in the foreign-born population just since March through August by 1.5 million people, and a good percentage of those people were actually in the labor force, and now they're not. State and local governments hired a lot of teachers and a lot of social workers to help out those people who crossed the border and wound up in their community. Now that's not happening. Companies that are looking at AI are saying, well, we're spending some money trying to assess how to implement AI. Maybe we should hold off on hiring because we may get some productivity gains from AI. So this lower interest rates is not going to really deal with these structural problems on the supply side in the labor market. And that being the case, all that stimulus is going to increasingly show up in the stock market and in other financial assets.
All right, Ed, always great insights. Ed Yardeni, President, Chief Investment Strategist over at Yardeni Research, kicking us off to the close here on this Thursday afternoon, post-Fed day, and, well, just an hour or so away from earnings out of FedEx. Another read, not so much on corporate America, but also on the economy, and, of course, the impact of tariffs. A conversation up ahead with Mary Lovely, Senior Fellow at the Peterson Institute. Stick with us. This is The Close on Bloomberg.
Well, all eyes are on FedEx as we await tonight's earnings report, where they're not expected to reinstate a full-year outlook due to the removal of the de minimis exemption, heightening unpredictability for the company. Joining us now to discuss is Mary Lovely. She is Senior Fellow at the Peterson Institute for International Economics. Mary, great to have you with us. So you think about the de minimis exemption, basically that allowed for duty-free imports of goods that were valued at $800 or less. It's only been a couple of weeks, so FedEx really will give us a sense of how companies are dealing with this. And I wonder, from where you're sitting, how you think that adjustment is going.
Well, we know that many companies suspended or partially suspended packages headed to the United States. So the rollout wasn't smooth. I think that companies will adjust, firms will adjust, but of course, with added time and added effort, extra services from customs brokers, et cetera, and that means higher costs for these low value items.
When it comes to just, I guess, how FedEx navigates this, is this something that they can sort of adjust their own costs in a way that, I guess, picks up some of the costs themselves, or is the idea that maybe they can broker a way for their shippers and for their clients actually to mitigate those costs on their end?
Well, I mean, I think they're going to have to look at both the short run and the long run. In the short run, they may, in fact, mitigate some of the costs. But in the long run, you know, the capital markets demand a certain return, and these costs are going to have to be borne somewhere. I think that FedEx and other shippers have encouraged de minimis packages and have encouraged use of warehousing to break up big packages into smaller value items. So I think that this aspect of their business is fundamentally going to have to change. That will take some time. It will also affect particularly the smaller businesses and medium-sized businesses that have taken advantage of this service to help get their packages to consumers faster and more cheaply.
Well, let's talk about it from the perspective of consumers for a little bit, because is the net effect for those shoppers basically just that they're going to be dealing with higher prices?
No, that's a good point, that we're also going to see fewer choices. Mm-hmm. So one of the things this did is that it brought in, shippers and suppliers who were able to reach smaller or niche markets. For example, we've lived through this sort of golden age where people could virtually find anything that they wanted, a red shirt, a blue tablecloth, whatever. And many of these suppliers will no longer be able to serve that market because the cost of doing so will be prohibitive. We're going to see this as a result of tariffs in a lot of different areas. Yeah. We've already talking to companies that are saying they're looking carefully at their product lines and culling, low volume products.
Mary, I do want to get your thoughts, though, a little bit more broadly beyond the consumer sector, beyond FedEx, and really this idea of trying to reshore or onshore a lot of manufacturing. Of course, a lot of us were somewhat, confused by what took place at that Korean plant here in the United States a couple of weeks ago. And I am curious, when we hear these big announcements from Korea and Japan and other nations about investing in the U.S., do we have any sense here that the environment is going to be conducive to them standing by those commitments?
Well, I think they would like to stand by the commitments, but some of the president's programs are in conflict with each other. And the roundup of skilled technicians at the Hyundai plant clearly was, illustrated one of those conflicts, which is this cracking down on visa usage and the desire to have foreign companies install advanced equipment. The U.S. wants to encourage investment in advanced manufacturing, and that often requires the employees who know that best to come here for a period of time, oftentimes to train Americans who will then work on the equipment. And the visa problem, the roundup there has left a very, very, very bad taste in the mouth of the South Korean people, who have always viewed themselves as strong allies of the U.S. This has been a very large political and diplomatic issue for the South Koreans, but it has other reverberations. The deal with the EU is rather wobbly, and the deal with the Japanese is completely unprecedented. And we've already seen Prime Minister Ishiba, he's leaving. It's going to cause political conflict within these countries. So these deals, while we're toting up the trillions of dollars that are being invested right now, actually look rather shaky.
All right, Mary Lovely, Senior Fellow at the Peterson Institute for International Economics, and as foreign companies maybe potentially seek to invest more here, there is still an effort to get our own homegrown companies here in the U.S. back on track. One of the biggest ones, of course, is Intel. And today, an interesting tie-up between Intel and Nvidia, a $5 billion investment. We're going to get the latest on what this means for the broader chip sector. This is The Close on Bloomberg.
Intel shares soaring after announcing that Nvidia will invest $5 billion in the company and co-develop chips with them for PCs and data centers. For more on the partnership, let's bring in Bloomberg Tech co-host Ed Ludlow. Ed, what do we know about how this arrangement came together?
Well, we spoke to Jensen Huang, the CEO of Nvidia, and Lip-Bu Tan, the CEO of Intel, a couple of hours ago. And they both were steadfast in the idea that the administration and President Trump had nothing to do with this deal. 12 months ago, engineering teams from Nvidia started talking to engineering teams at Intel, which would predate the more recent developments in the relationship between the administration and both CEOs. I'd also point out that 12 months ago, Lip-Bu Tan was not the CEO of Intel. It's basically a technology story, right? Intel's x86 architecture CPUs are pervasive in data center, and they're pervasive in PC. And what Jensen Huang was arguing in the course of the conversation was that it puts NVIDIA into new markets. They'll basically be a buyer of Intel's technology, and Intel will be a buyer of NVIDIA's competencies in graphics. The $5 billion equity investment, Jensen Huang justified by saying that if they believe in the product roadmap that they're working on together, entry into new markets, particularly into areas of the PC market that NVIDIA's not yet been, then they will see a return in that investment and it will be healthy. But again, there was no direct link drawn between the investment or the equity stake taken by the US government, which, of course, based on today's gain, is much bigger.
Shares up 23% here on the day. Let's get some additional insights out of Angelo Zino over at CFRA. And Angelo, I want to get right to it. I mean, back in August, you wrote a note talking about this idea of Intel needing a white knight. Is this it?
Well, it's not it yet, right? So when you think about how this partnership is structured, it really is on the product side. And when we said you needed a white knight, it was more on the foundry side. So I think overall this is a good first step. It kind of it bolsters, I think, investor sentiment and the fact that Nvidia is now more entrenched with that Intel, and Intel is now kind of within Nvidia's architecture. What I would say is the hope here, and I think why the stock is trading up as much as it is the fact that, hey, listen, at some point in time, you could potentially see Nvidia start to leverage Intel's foundry business. It remains to be seen, and that's a long tail, to be honest with you.
I know that's a long tail, but I mean, doesn't that seem key? Because I mean, Intel, certainly Lip-Bu Tan has been pretty explicit about this idea that if they don't get that sort of customer pipeline up for the advanced chip fab, that I think I'm quoting him directly, that basically they would have to get rid of it. So I am curious as to what incentive NVIDIA would have to ensure that advanced fab does actually come to fruition.
Yeah, no, absolutely. And you're absolutely right about that. And I would say this, I know, Jensen Huang basically said that, that the administration didn't have any role in all of this. But I know in the back of his head, I mean, you would think that there's got to be some sort of thought process involved in, hey, listen, this will put me in a better position. But ultimately, I mean, if you're Intel, you need that white knight, and potentially NVIDIA is that white knight at this point. At the very least, what you want to do if you're Intel You want to get to that next gen node. If it's 14A, that's where it's at. And at the very least, get some token business from Nvidia, even if it's in small incremental amounts, that could bolster enough confidence for others to potentially follow suit. And ultimately, if they meet whatever criteria Nvidia is looking for, you could potentially then see orders start to ramp in next future generations. But like I said, it's a long tail. This is going to be a multi-year process before you actually see substantial business from Nvidia on the foundry side.
Well, Angelo, I'm also glad you brought up the point that, okay, the CEOs are saying that the Trump administration had no hand in making this come together, but as you mentioned, it must be in the back of someone's mind. Having the Trump administration's blessing here, maybe implicit still, is valuable. And I will point out, of course, the Trump administration does have a 10% stake in Intel, a stake which got more valuable today. So this $5 billion stake that Nvidia has, could you see this increasing over time? Do you think that this is potentially the start of something?
That's a really interesting question. And to be honest with you, I have no idea. It could potentially go to be more. It would definitely require them to gain more confidence from Intel, on Intel's foundry efforts. But at this point in time, I would say $5 billion is probably it. I mean, you've got to think that Nvidia and Intel are frenemies. The tech industry very familiar with the whole frenemy approach, and I think this overall makes sense for both parties. But in the sense of when you look at I think you flagged it perfectly. The administration, they've got a 10% stake. You've got SoftBank, which also has strong ties with Nvidia. Also bolster their stake, and then you've got Nvidia here. And I think the sovereign AI opportunity is one where it gets interesting for a company like Intel. So we'll wait and see. But ultimately, I think this could be the start of something. I wouldn't necessarily bank on it, though.
All right, Angelo, really appreciate you taking the time. That is Angelo Zino, Senior VP and Equity Analyst over at CFRA Research. I mean, Intel shares just an absolutely amazing move here, up 23% at the moment.
Yeah, it's a shame we didn't have more time for Angelo, because I had a few more questions as to kind of how the deal works out in terms of the actual revenue generation, the sharing of revenue and profits coming out of this here. There are a lot of questions here about what this structure is going to look like. I understand why this is a good deal for Nvidia. The big question is, if you're an existing Intel shareholder, despite the pop today, long term, is this a good deal for them?
Well, I imagine that we're going to be talking about this much more because certainly a fascinating conversation watching this come together. But coming up, we'll be talking about the price of gold sliding as investors digest the Fed's rate cut. Natasha Kaneva joins us next.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. And boy, what an exciting market we're looking at. Stocks are rallying. Volume is through the roof. The Fed has cut rates. I'm pretty psyched.
Yeah, I mean, it was like this kind of a delayed reaction, which we've kind of seen in past Fed days where you kind of don't get a whole lot of movement the day up, but the day after once the market digests it. And it's going in a big way. It's basically all the big tech stocks, obviously chip stocks out in front here on this day. But we're also seeing a lot of movement in other asset classes as well, though not necessarily in the direction some people, I think, had hoped for.
Big time. It is a risk-on day, so that means that you have gold prices edging lower following the Fed's first rate cut of the year. This year,
heaven's metal, as I like to call it.
Heaven's metal, not like silver, that's the devil's metal. In any case, it has been a standout year for gold, which just last week eclipsed its inflation-adjusted all-time high that was set all the way back in 1980. Let's dig deeper into the commodity space as markets digest that cut. I'm pleased to say that joining us now is JPMorgan's head of global commodity strategy, Natasha Kaneva. Natasha, great to have you with us. So we learned this year about how gold performs when you have sticky inflation and a Fed on the sidelines. How does gold typically perform once we actually truly enter a rate cutting cycle?
Yes, absolutely. Thank you for having me. Yes, so you're absolutely correct. Gold had absolutely stunning performance so far this year. It's up about 40%. It's lower today, but it's absolutely normal to have those periods of a little bit of digestion. So what we're observing at the moment in the market is the commodities up about 5%, and commodities usually tend to perform exceptionally well when the Fed's cutting cycle begins. They perform really well about a month before the Fed cutting cycle starts, and after that going, 3, 6, 9 months after the Fed cutting cycle begins. So what is important is, actually the nature of the cycle. And during the benign cycles, for example, we had this example of 1995, 2024 was another of them. Commodities return about 15%. And interestingly enough, the two sectors within the commodities that perform the best are the energy and the precious metals. Industrial metals don't, in general, don't tend not to perform that well. So we do believe that the gold has more to go. Our target is 4,000 by the end of this year, 4,200 by the end of the first quarter of next year. So we believe there is a significantly more to go what we're observing at the moment.
Yeah, so gold right now at 3,600, certainly a lot of runway there. So precious metals, they're behaving as you might expect. What's the story, though, when it comes to oil? As you said, energy typically tends to perform here, but it feels like oil has just been stuck in a really well-defined range.
Yes, Katie, you're correct with your observation. So while our target from 2023 is that we'll see a $6 handle in oil for 2025 has materialized, what we have been observing actually so far is that the prices have tracked really well our first half forecast, but at the same time they are running both the fair value and our forecast, they're running about $3 to $5 above those. So our target was actually $63 for the third quarter, and we're averaging about $67. So what is also very important to mention in the case of oil is that if you take a look at the structure of the price, especially at the very front of the curve, it actually exhibited a very, very remarkable resilience. So both WTI and Brent have been trading in backwardation pretty much throughout the whole year, despite very aggressive hikes from the OPEC and visible buildup in inventories.
Natasha, I am curious when we talk about where oil goes next. I mean, there's just in light of what the Fed did yesterday, in light of all the focus right now on economic conditions, how much of the potential moves in oil prices up ahead are going to be directly tied to global macroeconomic conditions?
So this is, the questions that we're receiving the most. It's, usually we ask the question, do you see any signs of slowdown? Do you see any signs of the tariffs feeding through? The answer is we don't. We don't see this in the United States. We don't see it globally. Actually, in the case of the United States, we have been upgrading our oil demand this year. It's running above what we were expecting. The only sign we're seeing it's a little bit higher cost of production because of the higher steel prices from the tariffs, but that's pretty much it. So what we do believe in, and that was our original forecast, is that the main driver of the oil prices this year in 2025 and 2026 will be the surplus in the oil market. So we were expecting about 1 million barrel per day surplus. Actually, this happened. So the oil inventory is up about 1 million barrel per day year to date. But the biggest miss that we observed so far is, especially in the third quarter, is this lopsided buildup in inventory. So about 2/3 of the inventory build is taking place in China. I know, guys, you today wrote about that. But because of that, what it's doing, it's creating a valuation gap or a storage premium, as we call it. It's of about $3 to $5.
I am curious about just other parts of the commodity space right now. There's been a lot of talk about the material sector, minerals, I should say, and the idea of, obviously the industrial needs out there right now, but more importantly, the relative scarcity, at least for some countries, and to be able to get their hands on it. And I am curious as to how much that could potentially affect prices.
So I would say that this is the most visible in the industrial metals just because of the tariffs. So the market is still pricing in what exactly is going to happen in the United States because of the tariffs. As you know, that we had a little bit of a seesaw from the Trump administration about how to approach exactly the copper tariffs. We have already existing tariffs for steel and aluminum. But in the case of copper, what we see so far is that the United States continue to attract significant amount of volumes. The arbitrage is still open, and because of that, actually, there is a significant shortage of inventory of metals in the rest of the world, including China. And that's one of the reasons why the metal prices actually were holding up so nicely, even, copper trading at about $10,000. It's just this, again, lopsided built-in inventories this time around in the United States versus the rest of the world.
I want to talk a little bit about the different personalities of some of these metals. We were talking about gold earlier. Gold having a fantastic year, which, if you were just going by the textbooks, you might think that the economy wasn't looking too hot, but that hasn't been the case. It hasn't necessarily been haven flows that have been boosting gold. And then you think about copper, for example, and it has the nickname Dr. Copper because theoretically you should be able to glean some sort of economic read from the performance of copper. Is that still the relationship? Does that truth still hold?
I think so, yes. If you take a look where exactly copper is being consumed, it's consumed in, it's in construction, it's in the transportation, it's in consumer goods, in TVs and air conditioners. So indeed, it feeds through the whole economy. So it should be sending you good signals, and I do believe that it does. So global demand across commodities, not just in the case of the industrial metals, but we observe this in oil as well, actually has been strong year so far this year. I would have to say, maybe slightly above expectations, but in general, everything what we're seeing is that it was a solid year in terms of consumption. And I think the commodity prices actually pricing in at the moment, so up 5% in the last, since the bottoming in mid-August.
All right, Natasha, always great insights. Really appreciate it. Natasha Kaneva there. She's JPMorgan's head of global commodity strategy on a day where we are seeing commodities under pressure, particularly in the oil space. A big drop today in natural gas and a bit of a pullback today in gold after that record run ahead of that Fed decision.
It was interesting to hear from Natasha, though, that, at least the JPMorgan house view is that gold has a lot more runway here. It's been an absolutely fantastic year for gold, not necessarily because of haven flows, but still certainly some more blue sky there for Heaven's Metal.
For Heaven's Metal. Meanwhile, the Devil's Metal actually not doing too bad this year as well. When we come back, though, we're going to dig into, Katie's favorite topic. Food, eating, restaurant stocks having a bit of a rough day there. We're going to take a closer look here at the report that we got out of Darden earlier today and out of Cracker Barrel last night. That's coming up next. This is The Close on Bloomberg. One of the most shorted parts of this market all year long has been restaurant stocks, and maybe they got a reason why over the last 24 hours. Darden Restaurants and Cracker Barrel both in the red today, both reporting earnings over the last 24 hours, both reporting decelerating sales. Joining us right now to talk a little bit more about what exactly happened is Michael Halen, senior restaurant analyst over at Bloomberg Intelligence. And Michael, let's first start, of course, with Olive Garden. I was a little bit surprised by this. Pretty decent comp sales, 5.9%, but on a sequential basis, that was a step down from where they were the previous quarter. What's going on?
Yeah, listen, there was a slight decel here, but Olive Garden and Longhorn still put up over 5% comps, right? So these are solid numbers. I think expectations, to your point, were a little bit higher. I'd say my biggest concern here was the fact that restaurant margins, declined in a period in which they were able to drive pretty significant same-store sales growth. So that's our biggest concern. Management says the second quarter is going to be the peak of inflation. Beef costs are what really causing them heartburn right now. Longhorn obviously being greatly affected by that.
Yeah, I would imagine beef is pretty important to Longhorn. You take a look at shares of Darden down 7.6%. Cracker Barrel, an even worse reception in the market right now. You think about the recent logo controversy. It looks like that was actually translating in a material way into last night's earnings report.
Yeah, they put up a great quarter. Restaurant same-store sales also up over 5% there, 5.4%. And so things were inflecting higher also the first couple of weeks in August before the logo controversy. Traffic was only down 1%, and we have, alternative data that was showing sales up, 8-ish% early in the period. So they were off to a very strong start, but sales have decelerated pretty significantly here after the logo controversy and the decision to stop the remodels. I would say that the silver lining out of that report was that they were able to sign on 400,000 new loyalty members over the last 6 weeks. That's a pretty strong number for them. I think it bodes well. I think what we've seen here is a lot of passion for Cracker Barrel on both sides, and that's a good thing. There's a thin line between love and hate. I think it would be a lot more concerning if people were more apathetic about Cracker Barrel.
Yeah, well, of course, to quote the late, great Oscar Wilde, the only thing worse than people talking bad about you is them not talking about you at all. Maybe that is the case for Cracker Barrel. But as far as the broader restaurant industry goes right now, Michael, I am curious about the health of the consumer. There's been a lot of talk about trade downs, smaller tickets, adults ordering off the kids' menu, I guess, to save money. Is that real or anecdote?
It's largely anecdote. Listen, what we're seeing is a widening between the winners and losers, right? And we saw two strong same-store sales reports, even though the street didn't really like the complete report, but the top line is just fine. What we're seeing is a market share battle. Some chains are continuing to take share while other ones are slipping, right? But what we're seeing is stronger same-store sales than a year ago, and we're actually so far in the second half, we're seeing stronger same-store sales than we saw in the first half. So, we continue to think same-store sales are going to be solid here at least through the first quarter of next year. Margins through year end, that's our biggest concern, right? We have the Fed cutting while CPI is creeping higher. And so we may hear more companies talking about their margins
All right,
in the second half.
Michael, great to get some time with you on a tough day for the restaurants. That is Michael Halen of Bloomberg Intelligence. The close is coming up next. We'll be joined by Aaron Dunn. Don't go anywhere. This is Bloomberg.
We're kind of getting the best of all worlds. We're getting somewhat easier interest rates, financial conditions, and at the same time, we're getting some good news on the economy. So that would be good for earnings. And it's all about PE times Z. The earnings outlook remains very strong, and the valuation multiple is only helped by lower interest rates.
Well, a return to fundamentals, if you will. Maybe that that cut in rates provides a further boost to the bottom lines and to stocks. At Yardeni, kicking us off to the close just about 50 minutes ago.
Yeah, we are certainly seeing a big boost to stocks today. We could be heading towards a triple crown. The S&P 500, the NASDAQ 100, the Russell 2000.
Is that another horse reference?
All, of course. Yeah, I've got millions of them. But you can see they're all heading towards record high closes unless something amazing happens in the next 9 minutes. We'll see if we get there. Interesting bond market moves, though, following that rate cut yesterday. You can see the 10-year yield now climbing once again. We are above 410. We are higher by about 3 basis points. And you have to wonder whether this is the start of something, because I'm getting deja vu to this time last year.
Yeah, absolutely. At least for right now, investors seem to be pleased with where we stand today and maybe the potential direction ahead. But big questions right now as to what the complexion of additional gains in the market looks like. Aaron Dunn joins us right now, Managing Director and Co-Head of Value Equity at Morgan Stanley Investment Management. And great to have a value guy on a day like today where the Russell 2000 outperforming the broader market by the second most so far this year.
Yeah.
That sticks, you think, longer term?
I think small cap has really lagged, right? If you look at the major indices, they're all hitting new highs. Small cap has really lagged that. It's hitting, I think it's 2021 highs, but it's back. It's not pushing new all-time highs. So we'll see. I think the challenge for us has been the lack of sort of economic growth outside of AI, meaning, the market's really been bifurcated, meaning, I think 70% of the market's returns this year were driven by the top 13 stocks, and those are up over 50% on average. Everything below that has really been very challenged with economic growth. So when we talk to companies, we talk to management teams, it's not that great out there, right? It's challenging. China's weak. U.S. has been a little not that great. It's fine, but it's not great. So we think that's the next leg here potentially with interest rate cuts and heading into 2026. And I think we're going to see the lagged effects of the tax bill coming through as well in terms of tax sort of stimulus for consumers and companies.
And of course, a lot of investors are looking beyond the official government data, looking to corporate America to try to get a read on where the economy is. We should point out we get FedEx earnings later tonight, which should provide a little bit of a sense of the health of the consumer. But you're also keeping track of some stocks yourself, including Ball Corp, a big maker of cans and bottles and jars and other things that basically effectively are consumer products.
Yes, right. Yeah. So we are long-term investors, and we do look for value in the market. And I think that's one of the things that, as an investor in this market, I think you can be excited about is there's a lot of opportunities out there if the economy starts to improve, right? So if the economy improves, there's a lot of companies that are going to benefit through housing, consumer spending, et cetera. So Ball is one of those. Ball, to me, the risk reward is extremely attractive here. It's an extremely well-run company. They make beverage cans primarily. Really, the big debate here around beverage cans has been the secular decline of beer consumption. Is that cyclical or is that secular? And that's a big debate that the market's having. Fortunately, recently, energy drinks have sort of filled the void of the decline in beer consumption. You know, I think next year with the World Cup coming to the United States, in North America, we're going to find that it's is beer consumption really in decline or not? And so that makes us very excited. So when I look out a couple of years for a company like Ball, I think the downside's very limited, and I think they have a lot of opportunity. They generate a lot of free cash flow. They earn great returns on capital. They return that to shareholders. So very excited about that one.
Well, I also love the idea that we're going to really get to test that thesis about beer consumption once the World Cup rolls around. But you mentioned housing. Let's talk about housing through the lens of Lowe's, one of your other holdings. And it just feels like Lowe's and some of their peers have been one of the victims of this frozen housing market. And you think about some of the areas that really need rate cuts here. I have to imagine housing is up there.
Yeah, it is. And so Lowe's really benefits from their same-store sales really track existing home turnover, right? Existing home sales, which are at the lows we've seen since the mid-90s, right? So there's no turnover out there. People aren't spending money on fixing their homes up, right? So they're not painting. You see that from the paint makers as well. There's just not a lot of home renovation or improvement happening. We think that coming off this bottom, interest rate cuts will help. I think you need a 5 handle probably on mortgage rates to start to see that, right? And you're also going to see durable goods sort of reacceleration, I think, likely start to happen because really a lot of people bought white goods and durable goods in the pandemic, right? And so you're 5 years past that or so. So you're starting to look at sort of a replacement cycle for that. So there's been a real delay in spending from consumers, and we think that probably turns. And Lowe's is, from a company perspective, has been really interesting as well because they've bought 2 businesses recently that are going to really increase their pro exposure.
Right.
So Lowe's trades at a 4-turn discount to Home Depot. That's a lot of that because Home Depot has a big pro business, and we think that Lowe's is actually trying to build that. I think that's going to take their pro exposure to 36% of total sales, which is starting to track closer to Home Depot. We think that's exciting.
Well, I just want to dig into a little bit more about why you think we're heading into this inflection point for consumer spending. We've been talking, of course, about the Fed, the expectation for more cuts on the monetary side, but talk to us too about how the fiscal fits in when you look into 2026.
Right. So I think the tax impacts of what happened over the summer with the tax bill is going to be a stimulative measure to the consumer. I think a lot of it's been, a lot of it's tied into corporate confidence. Consumer spending has been weak on the lack of sort of concerns over jobs. Really, consumer credit looks quite good, right? It doesn't look like we're entering a consumer recession, so to speak. And so what we really need is better corporate confidence to drive better jobs data, but also heading into next year, we think the lagged effects of interest rate cuts, the benefits of some of the tax measures that were in the bill over the summer, whether it be no tax on tips, no tax on overtime, SALT deductions, all those things will be positive for the consumer. And I think a lot of the volatility this year is going to start to at least settle a little bit in terms of what the future looks like. And so I think that's all going to kind of culminate in a better consumer. And I think post-COVID, I still think we're working past this pandemic. There's a lot of stimulus given to the consumer. It was pulled back. Now they've you look at average savings is down to about where it was pre-pandemic. So we think that's starting to normalize. You're going to come off a better base for the consumer here.
All right, Aaron, we have to leave it there. Aaron Dunn, Managing Director and Co-Head of Value Equity at Morgan Stanley Investment Management. As we count you down to the closing bells, it is green across the screen. As you said, setting up the potential for a trifecta. Is that what you said?
A triple crown.
Triple crown, excuse me. Trifecta, that's horses too, right?
I guess in a loose sense, but triple crown, firmly horses again. Right. It does really speak to just this unleash of risk appetite that you've seen in the wake of that Fed meeting. But as you pointed out, a little bit of a delayed reaction. This wasn't necessarily the mood music this time yesterday. I
also want to point out, I know you're so focused on the Triple Crown,
I am.
But we should point out, it's the S&P, it's the Dow, which I know you love, the NASDAQ 100, and the Russell 2000. That's four, Katie. All potentially here going to closing at record highs simultaneously, which would be the first time that's happened since 2021.
Unbelievable.
Do you remember where you were that day back in 2021?
I probably, if you give me a date, I probably would.
All right, we continue to count you down to the closing bells, parse all of today's market action, and push ahead to some consequential earnings starting now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. It starts now. Carol Massar, Tim Stenovic, they're in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube here on a phenomenal day for markets. outperformance by the small caps, but more importantly, a little bit of synchronicity here when it comes to the major indices.
Right. We are kind of on alert to see whether or not we get records in the Russell 2000, the NASDAQ 100, the Dow Jones Industrial Average, and the S&P 500. If it happens, it would be the first time it has done so since 1921. I always
that would be 2021.
That would be incredible.
That would be historic.
Remember back then, guys? Since 2021. And it has only happened 25 other days this century. So it would be pretty significant. And to see all of that strength, bullish sign, do we read into that? I don't know.
It also comes against a backdrop of some worrying signs about the consumer, though. I think it's important to note some stuff about the labor market. Look, we saw what the Fed did yesterday as a result of some of those signals. So something to keep in mind is that, yes, we could see this in the markets, but look to other parts of the economy. Look to the economy for what the consumer is telling us about the position that they're in.
You're kind of bumming me out. Let's talk a little bit more about this rally. Come on. I want to point out that it's coming on the back of very strong volume. There's a lot of conviction behind this buying right now, at least on the S&P 500 volume, almost 25% greater than the 30-day average.
Yeah, and I just want to point out, too, I mean, I know we see we're looking to the economy, but we should point out we should also look for corporate earnings because we do get a couple of consequential ones after the bell tonight out of FedEx and the home builder Lennar, which maybe should give us a little bit more insight into exactly how healthy the economy is. As we get the closing bells in New York, it does look like Katie got her triple crown here on the day. The Dow Jones Industrial Average closing up more than 100 points or 0.3%. That's a record high. The S&P 500 closing up higher by about 32 points or 0.5%. And I believe that is a record high. The NASDAQ 100 at a record high. The NASDAQ Composite up more than 200 points to 0.9%. And how about this, guys? The Russell 2000, which has not closed at a record high, the longest stretch of not hitting a record high, going all the way back to 2021. That streak is now over, a gain of 60 points, 2.5%, closing at 24.67 and change.
Pretty remarkable. I'm just going to go back to the S&P 500, guys. God, I feel like we have so much to talk about when it comes to the markets. Hey, most names in the S&P, 320. Katie actually gaining ground today, 181 losing ground, and you've got 2 unchanged.
Absolutely, some good breath there. Let's take a look at the circle and see how it broke down on the sector level. You can see a lot of green on this screen. Tech was your big gainer on the day. That sector higher by about 1.4%. Some other worthy mentions here. Industrials having a good day. So too did communication services. If you're looking for some red, though, you can look to consumer staples. That was your biggest loser on the day.
Why would you do that? Why would you look for the red?
Some people do. We've got some bears on this
I have to look at those.
Yeah, it's sort of your
like my
job, Tim.
but-
Well, you probably found some in consumer staples. That was your biggest loser on the day.
All right, let's get to some individual gainers. No surprise, shocking Intel atop that list. Top gainer in the S&P and the NASDAQ 100, finishing with a gain of about 23%, at its highs up as much as 30%. This, of course, after Nvidia agreed to invest $5 billion in the company. The two are going to co-develop chips for PCs and data centers. So just so much going on in this name. The whole SOX, I should say, Philadelphia Semiconductor Index, we saw many names, and I'm just going to pull it up real quick. I think almost
that's at a record high as well. Carol, I'm just going to jump in here. We're getting FedEx earnings crossing the wire right now. The company providing its fiscal first quarter numbers here. EPS $3.83 a share. That is a beat. It looks like on the revenue side, $22.2 billion, a modest beat there as well. But the company does appear now to be back to putting in its forecast. Remember, it had pulled its full year forecast because of uncertainty here about the outlook with regards to trade policies and geopolitical issues. Now saying that for the full year, it sees adjusted EPS in the range of $17.20 to $19. The street was looking on average for $18.25 here. I also just want to point out here, when it comes to the revenue side here, they do appear to be hedging their bets just a little bit more on that. The company has a lot of asterisks in this press release right now with regards to some of the issues going forward, with regards to not knowing what's going on with policy. But overall, we should point, this is now a company that had actually reported flat to declining revenue in 8 of the past 10 quarters. That streak is now broken. 3% growth here in the quarter, and guidance going forward of 4 to 6% for the full year.
And you can see shares popping a little bit in the after hours trade. Just the fact that they issued a full year profit outlook is a surprise here. It was a very wide range when it comes to full year adjusted EPS expectations, $17.20 to $19. But again, Tim, just the fact that they did come out with some numbers. Sentiment had been so low on this name. Right now being taken as good news. We'll see if that sticks.
Yeah, shares up about 3.7% in the after hours. Ahead of this call, Raj Subramanian, the FedEx president and CEO, saying that earnings growth underscores the success of their strategic initiatives. They're flexing our network, reducing our cost to serve, further enhancing our value proposition and customer experience. Strategic initiatives paired with our operational data platform for moving 17 million packages through our network daily position us well to serve customers in any environment.
All right, and I am also taking a look at shares of UPS. They're not apples to apples when you think about both of these companies, but nonetheless, UPS also taking a look at this one popping in the aftermarket, up about 1%. So a little bit of movement in that name, as well as, again, we see FedEx certainly rallying in a big way, up about 5% here. All right, let's go back to some of the individual gainers. I mentioned Intel, that's out there, finishing the day with a 23% gain. We saw the stocks also moving up, and most names in that index 26 higher. Stocks up about 3.6%. So the whole semiconductor space lifted by this news. Novo Nordisk, the ADRs that trade in the United States, that one finishing with a gain of more than 6%. This stock has been on a tear, rallying up 5 days in a row, and it's up around 13% in that time frame, the most in a month after its diabetes blockbuster Ozempic beat Eli Lilly's older drug Trulicity in a real-world survey of certain U.S. patients. So some optimism in that one. Want to mention a company we don't talk about it, 89 Bio, ticker's ETNB. This stock up 85% in today's session. Roche, and this kind of plays into this whole subject, an area of weight loss drugs. Roche said it will acquire this biopharmaceutical company for up to $3.5 billion, bolstering Roche's pipeline in the market to treat obesity and related illnesses. 89 Bio plays into this field in particular. And then, because if I don't say it, Romaine's going to say it, we did have another IPO today. NTSK, Netscope. I know. Sorry. Finishing the day, it was up as much as 28% in its first day of trading, but finishing with about an 18% gain. This is after it priced at the top end of its range. Do you have anything, Romaine?
Don't worry. I'll get you back tomorrow. If you're here tomorrow. I know you worked the 4-day weeks here.
Moving on.
Tomorrow's day 5. ARM Holdings. I wanted to start with ADRs of ARM, down 4.5% today. This is the semiconductor design and manufacturing company after Nvidia agreed to invest $5 billion in Intel and said the two companies would co-develop chips for PCs and data centers. Now, Nvidia currently designs its own processors, which work alongside the accelerated components using tech from ARM Holdings. The Intel tie-up should have no impact on ARM, according to Jensen Wong. Nvidia is proceeding as planned with ARM-based products, he said. Still, investors a little skittish on the stock today and sending shares lower. Live Nation also falling today, down 2.8%. The FTC in 7 states sued Live Nation Entertainment and its Ticketmaster subsidiary for failing to stem the use of automated ticketing bots and large-scale resale operations. The FTC alleged that Ticketmaster's actions violated the FTC Act and the Better Online Ticket Sales Act, and the company took in $11 billion in fees on primary and resold tickets between 2019 and 2024. And finally, watching shares of Walt Disney down 1.1% today. It's the parent company of ABC. This after the network said that Jimmy Kimmel Live will be off the air indefinitely amid a backlash to remarks that Jimmy Kimmel made about the killing of Republican activist Charlie Kirk. The move was sparked by Nexstar Media Group, which owns dozens of ABC TV affiliates, saying that it would pull the show from its stations of remarks that were, quote, offensive and insensitive. Disney shares down by 1.1% today.
All right, let's take a quick look in yields. We did see a bit of a sell-off earlier in the session, though that sell-off did abate just a little bit. Nevertheless, yields are higher across the curve, about 2 basis points on the shorter end. When you go out to the 30-year, up about 4 basis points. So a bit of a bear steepening here on the day and a widening here on that 530 spread here. So a big question right now as to how the market, the difference of interpretation of what the Fed did yesterday between how the stock market is reacting and how the bond market is repositioning.
Yeah, really, a really important point. point. We'll see how this kind of, I feel like, plays out as we start to get more data points or the next round of data points. All right, guys, that's a wrap. Watching FedEx shares up more than 5% here in the aftermarket following its latest quarterly update. Our wrap, our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Romaine and Katie finishing up there on the close, and Tim and I finishing up here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow. I will be here, Romaine.
So you say. And our coverage continues here on Bloomberg Television. A closer look at the biggest mover in the after-hours trade, and that is FedEx. They're out with their earnings and a reinstatement of their guidance. A fuller breakdown when we come back. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick here on a record-setting day for U.S. markets, a day after the big Fed decision to cut rates at least once this year and maybe to telegraph to the market further rate cuts for the rest of the year as well. The S&P 500 closing at a record high. The NASDAQ Composite and NASDAQ 100 closing at a record high. The Philadelphia Semiconductor Index closing at a record high. The Dow Jones Industrial Average closing at a record high. And for the first time since 2021, Katie, the Russell 2000 closing at a record high.
All right, we are breaking records left and right. Let's take a look at some individual movers and specifically at shares of FedEx in after-hours trading. We just got the numbers a few minutes ago. You can see shares up 5%. FedEx coming out reinstating its full-year profit outlook. Investors taking that as a sign that maybe the C-suite has more clarity on the future of their business, even while grappling, of course, with trade policy and tariffs. To be fair, the bar was low. FedEx shares down 18% year to date through today's close, but look at that pop, Romaine, up almost 6%.
Trying to get their mojo back here, and we talk about the growth in the most recent quarter, but more importantly, the top line guidance for the full fiscal year, 4 to 6% revenue growth, well above what the street had priced in. Peter McNally joins us right now, global head of sector analyst over at Third Bridge. And I guess the big question here, Peter, is this really the start of a material turnaround on the top line for FedEx?
Well, we've been waiting for this, for a long time. And obviously just 3 months ago, FedEx management punted on that decision. And it was understandable. It was, a few weeks after Liberation Day, and there wasn't a whole lot of clarity, in the market. But they delivered a good quarter. And this, might be the start of the payoff that investors have been waiting for years. I think I counted 5 record highs of indexes that you noted. Mm-hmm. Here was FedEx still hadn't recovered, to the levels it was at before Liberation Day. So as you note, expectations were pretty low here.
Yeah.
The cost-cutting story has been going on for years. And now here we are with potentially some top-line momentum.
Yeah,
with some economic headwinds.
Yeah, and to that point, we should point out the one index that I did not mention was the Dow Transportation Average. And of course, if you believe in Dow theory, certainly got some catching up to do. But when it comes to FedEx specifically here, I do just want to point out, Peter, they make it very clear in their statement to shareholders, a lot of asterisk about the idea that everything right now is based on current economic forecasts, current fuel expectations, current geopolitical issues, current international trade law developments. And we've seen how fast things can change here. And I do wonder if there's a story for FedEx that goes beyond that isn't just about policies and geopolitics. It just is simply about what we're spending and what we're shipping and buying.
Yeah, look, FedEx has been at it for years. And, our experts here actually think that FedEx is going to outperform UPS, going forward from a volume point of view. And they've elected to walk away from some unprofitable, businesses. The last 3 months have been pretty good, despite what, hasn't been a great economic backdrop. And all the investments from years past may be, finally paying off, which has been really hard to see, over the last year as the economy has slowed down. Give management some credit. They haven't taken this slowdown, on the chin. They have worked to cut costs and restrain spending. And now maybe the payoff is finally here.
Well, let's talk a little bit more about the competitive landscape. You mentioned UPS. We were just showing that shares are also higher after hours to the tune of about 1.7%. So your expectation is that FedEx volumes will hold better up better than that of UPS. Does that say more about the decisions made by FedEx management or by UPS?
Well, I mean, there's a couple things, going on. Like FedEx walked away from this USPS business, which was low profits. It's going to help margin longer term. In the short term, there is this, just lost revenue. UPS does have an advantage, let's say, in the healthcare business, but it's not that big of a needle mover just yet. And FedEx is, just a bigger player in the international scene where they do have, advantages in custom brokerages and things like that. So when we net it all out, we actually think that FedEx is a better volume outlook than UPS. At the same time, UPS had really a step up in structural costs with that labor contract that they signed a couple of years ago. So they're less competitive, we would say, than FedEx, which is, had this major drive program that's been going on for some time that really lowered their costs.
And let's talk a little bit more about the share performance, at least of FedEx. Having a big pop right now. They've had an awful 2025, though. And you take a look at the 5-year chart of FedEx, it's pretty much gone nowhere. It's higher by about 2% over, that time frame, which is basically standing still. And Peter, I feel like there's just this perception that FedEx isn't necessarily growing, but it's trying to defend here. Is that unfair?
No, it isn't. I would not call that unfair, in any way. And there really hasn't been a whole lot of top line, momentum. But as we said earlier, the real payoff is going to be when all this cost cutting, you get some volume growth here, and that they can show that the operating leverage is stronger than forecast. And in 2026, we're going to get the spinoff of the FedEx Freight business, and that's something that the market values much more highly than, this mix of transportation businesses that, FedEx or even, UPS have today. So that's a potential catalyst. But again, that's 9 months away at this point, unless management's going to say something later tonight to pull that forward. But that's a June 2026 event.
I am curious, too. Well, once we get to some of the other mechanics of the business, obviously the spinoff, getting rid of the freight, or I should say getting rid of it, but you know what I mean, spinning off the freight business and some of the other things here. Does that create a better profile for you, financial profile for this company in your view?
Well, I think they would. I think the big change that they had, let's say, versus 3 to 4 years ago was the capital discipline. I mean, like a lot of companies, they chased the post-COVID growth and threw a lot of investments in the ground, trucks and centers and things like that. And then things began to slow, and they weren't earning a whole lot of return. But, I believe, at this point, FedEx's CapEx as a percent of revenues is the lowest it's ever been, in its history. So they're being more careful, with their dollars, and they're not losing out really on share. I mean, the backdrop is this has just been a tough business, and there hasn't been a whole lot of volume growth. And as we move forward, the better capital discipline, and the company has been buying back stock and increasing dividends slowly on the dividend side, that there is an investment case to be made in the future.
All right, Peter, great to get some time with you. Appreciate your instant analysis here. That is Peter McNally. He is Global Head of Sector Analysts over at Third Bridge. Now, coming up, we're sticking with those FedEx results. We'll keep the conversation going with Craig Fuller, the founder and CEO of Freightwaves, next. This is The Close on Bloomberg. Well, we're keeping an eye on shares of FedEx, which are higher after hours to the tune of almost 7% following the package shipment company reinstating its full-year profit outlook, a sign potentially that the company is gaining some clarity on the future of its business. Joining us now is Craig Fuller. He is founder and CEO of Freightwaves, which provides insights on the freight and logistics market. Craig, so you think about why this is a surprise. It feels like FedEx was widely expected to not reinstate their guidance, not issue any guidance at all, coming back to the fact that you do have the ending of the de minimis exemption. So to see them come out with some sort of forecast being taken as good news, what's your read?
Yeah, I mean, it's been a brutal couple of years, frankly, for the logistics sector. This year has been abysmal for everybody in freight. You mentioned, you guys were talking earlier about FedEx's chart. UPS's chart also doesn't look well. the reality is that freight volume in the domestic U.S. market is actually what we're looking at actually matches the chart. So it's no surprise for people that are in logistics that these stocks have been beat up. I think what we're seeing now is a lot of relief. And, FedEx putting in forward guidance, I think, provides a lot more confidence that perhaps we've seen the bottom of we're starting to see market stability. We're hearing it. We're seeing it in the data. The worst appears to be over with as it relates to international trade fluctuations and demand destruction that was caused by a lot of the tariff changes. I think moving beyond that is quite positive, and FedEx specifically due to de minimis, I think the fact that they are affirming guidance or putting out guidance that we can depend on is telling us that they believe that the worst is over, and they're starting to see recovery in some of the volumes that they perhaps would have lost.
And Craig, I mean, we've also been making the point that the de minimis exemption only ended in late August. It's really only been a couple of weeks. So we have some relief today in the shares, but what do you think the longer term impact is for a company such as FedEx?
Well, I think the Postal Service is certainly more exposed. It's interesting because there's two sides to this. One is you lose some of that international volume that was impacting, that was driving a portion of FedEx's business. But you also gain a lot of need for enhanced custom services, fulfillment centers here in the U.S. And so while it is a loss in volume across their network, they actually make more money not moving freight, but actually on a per the unit economics are more favorable for some of the value-added services that FedEx is going to be able to pick up and be able to benefit from, like some of the domestic sourcing centers, the domestic fulfillment centers, and some of that custom brokerage, which is much higher margin. I think they actually, in some ways, can benefit from some of the way that de minimis laws are changing.
I am curious, though, on that point, though, and as you're speaking, we should just point out to our viewers to check in on UPS. Those shares now moving higher in the after-hours trade. This after UPS confirming that they've actually abandoned that deal to buy the Mexican parcel carrier Estafeta, which was basically supposed to be a way to nearshore more of their capacity away from international markets. And I am curious as to what the complexion of that nearshoring effort, not just for UPS and FedEx, but really all around, looks like at this stage, Craig. Is this something that companies are still trying to push forward on, or are they just kind of hoping to wait out whatever's going on in Washington?
No, everybody believes that the nearshoring story, the reindustrialization, is a permanent move. I think there's been a lot of noise about, at least in logistics markets, they believe this. We certainly believe that this is an inevitability, that we're going to see reindustrialization, investments, and policy. I think, frankly, what has happened this year is that there's been so much uncertainty due to tariffs and so much whiplashing that's been caused by all of the different changes in policy and all of the attempts to put in some pretty extreme tariffs that have surprised many people. I think it's actually slowed down a lot of that potential investment. But the idea of having American reindustrialization is a bipartisan policy. And the movement in the logistics sector is certainly to expect that and to benefit from that. And so I don't think that what we've seen the last couple of months necessarily is suggesting that like we're beyond the chaos, if you will. And I think that's probably providing a lot more confidence to FedEx, but it's also reinforcing the long-term reindustrialization story that I think will play out over the next decade.
And who does that benefit? I mean, beyond just the bigger players out there. I mean, can we kind of look to some of the trucking industry here? I mean, who benefits? Railroads? Who?
Railroads are the biggest beneficiaries because they just have so much capacity. We saw the Union Pacific, Norfolk Southern. We've seen some new intermodal networks with CSX and BN, and even the Canadian railroads are getting involved in this. The railroads are big beneficiaries because they benefit both in the commodity flow. So one of the things that's sort of poorly understood about transportation networks is when I'm producing products in the United States, I get the inbound flow of raw materials into my manufacturing plant. I get all the source material that comes in to fulfill that product, and then I get the output as well. When I'm bringing products in from containers, I'm only moving it from the port across the United States to its destination. Mm-hmm. But when we have manufacturing, it's an exponential increase. It increases a multiplier of transportation services because of all that inbound that you get in addition to it. And so Reindustrialization is fantastic for domestic freight networks. The railroads are going to benefit. The LTL networks benefit. Companies that are in warehousing, like Prologis, are going to benefit. It's really important for domestic transportation that reindustrialization takes place. And this is one of the things that could play out over the next decade.
All right, Craig, I have to leave it there. Always appreciate it. Craig Fuller, founder, CEO of Freightwaves. When we come back, we're going to talk branding, and we're going to talk the Dallas Cowboys, one of the most valuable franchises in the NFL. All right, let's take a look back at this day in history. 37 years ago, September 1988, and Nike's launch of one of the greatest branding campaigns in history, Just Do It. It was a knowingly understated yet unknowingly monumental pivot for a sneaker company run by Phil Knight, who we should point out was notoriously reticent about mass advertising. But in 1988, Nike's sales, they were slumping, overtaken in market share by Reebok, which was riding the wave of the leg warmer aesthetic aerobics boom. But ad executive Dan Wieden, he had been working with Nike for 6 years, largely on print ads in the back of running magazines, but had been really trying to nudge them into so-called performance-driven TV spots featuring professional athletes like Bo Jackson, like Michael Jordan. But Wieden, in the 2009 documentary Art and Copy, recounted how those various campaigns were individualistic and had no real unifying message around the Nike brand as a whole. So Wieden sketched out several slogans that he thought could tie all the ad campaigns together. And in September of 1988, an ad debuted showing a simple moving shot of an 80-year-old man named Walt Stack jogging shirtless across the Golden Gate Bridge. He quips that when people ask how he keeps his teeth from chattering in the winter, he responds, "I leave them in my locker." The screen cuts away to white letters on a black backdrop, "Just Do It." The ad, it was a hit. A mantra of self-empowerment that suggested Nike shoes were for everyone. Advertising Age would later rank Just Do It as the #2 ad slogan of the 20th century, second only to Diamonds Are Forever and ahead of Finger Looking Good over at KFC. But Nike executives have since admitted they were actually taken by surprise of the slogan's resonance, a slogan that Businessweek magazine described as being less important than the universal idea that underpinned it. Liz Dolan, a former chief marketing officer, she told the Washington Post in 2018 that each year, Nike would actually try to think of something to replace Just Do It, but ultimately would return back to that same iconic slogan. In fact, just this month, Nike launched a new campaign that updates the phrase to, quote, "Why do it?" which, given the everlasting life of Just Do It, might be an appropriate question for Nike's ad team as well.
Well, Nike is also the exclusive provider of uniforms for all 32 NFL teams. So on that note, are you ready for some football? Few names are as synonymous with the sport as the Dallas Cowboys. The team is currently 1-1 this season, and I'm pleased to say that the woman behind the brand of this iconic name joins us now. Charlotte Jones, she is the chief brand officer and co-owner of the Dallas Cowboys. Charlotte, great to have you with us. So when you're talking about a name, a brand as iconic as the Dallas Cowboys, how do you approach not only maintaining that, but building it as well?
You know, Katie, I love that you opened up with the Nike story, because that is very symbolic of our journey into marketing and into branding that started way back in the 90s for the NFL, and because of the Cowboys and our bit of a renegade approach to marketing in general. But, you know, when I think about our brand, I really think what keeps us straight and narrow is really understanding who we are as a brand. And that's really based on 5 things. We know we're about tradition. We know we're about the Bob Lillys and Roger Staubach and Tom Landrys that came before us. But we also know that if we stick to tradition, then we become nostalgic because it's just generational. So we have to figure out ways to go beyond while protecting that tradition that made the Dallas Cowboys. On top of that, we know it's about competition. Our fans just want to win. So they really don't care much about anything else, but show us how you're going to get us to the next level. So we always have to keep that in mind. And on top of that, it's entertainment. We know that people give their last resource to be a part of who we are on game day and beyond. So we have to over-deliver in that category so that they know that they're there for a reason. And then it's about business. But you can't be too much about business because people just want to hear about the game. But you have to have business to make it all work. and then it's innovation. I think in our documentary series, they called it disruption. So maybe it's a little disruption, but it's certainly about innovation. But it's all 5 of those that really make us who we are.
Well, let's talk about how 2 of those interplay with each other, because you mentioned knowing yourself, sticking to tradition, but then how do you thread that needle with innovation and potentially bringing in new fans? Because it seems like it could be difficult at times.
You know, I think it's always difficult because what appeals to an older generation is certainly not what's relevant to today's youth. So we have to be cognizant of that. They don't even get their content the same way. That television that my grandfather sat us in front of is not really how my kids and our grandkids will receive our games on a game day. So we always have to recognize that we have to meet our fans where they are. And that includes their depth of avidity with who we are at the Cowboys. So I really, never really liked the word brand. I kind of think I take that from Roy Disney, who said, brands are something that farmers do to cattle to tell their cows apart from each other when you don't have anything distinctive to offer people. But we're more of a lifestyle. We're more of a culture. And I think as we approach that and we do different things, we do the things that are basic, but then we also dig into where people are and what they truly value. And I think that's the key to everything that we do and how we analyze it.
Charlotte, I want to get your thoughts also on the sort of the in-person experience. I mean, AT&T Stadium has become kind of a template for a lot of other sports teams, not just in the NFL as well. I remember when that built and the price tag, a lot of people kind of scratched their head. But it has kind of become the go-to place, whether you actually want to watch the game or you just want to hobnob with your friends or make business deals in, the 400 luxury suites that you got around there. I mean, what was the sell that you had? Firstly, I had to make the Jerry. But then more importantly, once it was up and running, what was the sell to get people in the door to buy those seats, to buy those suites?
I think it was about what can we build and how can we over-invest in an experience so that everybody that walks through that door, first of all, says, wow, I can't believe I'm here. And then when they leave, they say that, oh my gosh, that was way better than I thought it could ever be. And I think one thing that always resonates with me is that we have to understand that our greatest partner, our best partner, our media partners are actually our most significant competition because we have to get people off their sofa, out the door, and over to the building in order to actually make that experience because they can get it at home in ways that we never dreamed they would be able to get an experience. So we have to do something very different. But we also, as we think about that, we also have to understand that only 7% of NFL fans will ever come into a stadium. 7%. Wow. So we have to think about how do we reach those fans in other ways outside of our building while we focus on who's there, but then also engage people through the television or through whatever screen they're watching on to be a part of who we are.
In addition to obviously what actually plays out on the field itself with the players, of course, the other sort of iconic element of your brand, and forgive the use of the word brand, are the Dallas Cowboys cheerleaders themselves. And of course, they've been in the spotlight as of late because of the Netflix series and also because of the Netflix series, but also because of what is now, at least in their view, a more appropriate pay scale. Talk a little bit about that.
Sure. Well, the cheerleaders are iconic for us. So it began back in the 60s when we began as an organization. And in the 70s, it was really Tex Schramm's brainchild of how do we add entertainment? What else will people come and get to enjoy while they're in the building? And he's the one who first thought of putting the women on the sideline, having a dance, having an iconic uniform, all of those things came from back then. So over the years, this has all evolved in their talent level and what they do, where they go, and how we utilize their iconic nature to bring a little bit of a cowboy persona across the world. Probably one of the most important things that we do with them are our tours overseas. So that's about bringing a little of America's team to you stationed somewhere out of the country and getting that avidity. And I think, as the documentary will unveil, if you haven't seen it yet, This was all about making sure that the girls felt valued and happy. And in the end, they did. So that was really important for us.
All right. Well, it's really amazing just to see not only, of course, just the overall valuation and power of the Cowboys brand over the years, but particularly your contributions to it. And I just want to say, you know, as a lifelong Bears fan, someone who grew up in the shadow of Soldier Field, I don't know if you're traveling there on Sunday, but maybe you can give the owners there a little bit of advice on how to revitalize that team. Go Bears and go Charlotte. Really appreciate you taking time for us. Charlotte Jones, Chief Brand Officer and co-owner of the Dallas Cowboys.
Appreciate it. Thank you.
All right, let's get back to this equity market right now. There's some excitement there as well. Let's take a look at shares of FedEx. That's exciting. Up after hours, now higher by more than 7%. Of course, they reinstated their full year guidance. That's also lifting shares of their friend UPS. Frenemies maybe. UPS shares higher by about 3% as well. We're awaiting results from Lennar. They haven't crossed yet, but you can see that shares a little bit higher in anticipation. And to end on a sour note, take a look at shares of Scholastic logging a wider first quarter loss, revenue hit by volatile school funding. This is Bloomberg.
Leisure and hospitality spending, we talk a lot about it on this show. It's been holding up. Our next guest is a power player in that field, a two-time James Beard Award winner with acclaimed restaurants across the United States. His latest venture, though, is going to take him to the Bahamas, where he's set to unveil his latest project, Loyola, this fall. You may recognize him from the hit show Chopped. Celebrity chef Scott Conant joins us live here in Studio 2. Scott, great to have you.
Nice to see you. Thank you for having me.
I've been watching you for the last 20 years, however long Chopped has been on. I've been to your restaurants here in New York, and I guess I got to get to the Bahamas sometime soon. November 7th, it's opening. This is a big undertaking. This isn't just some small little restaurant, you know, tucked into some corner of Manhattan here. This is what, 9,000 square feet of space?
It's a 9,000 square foot space. We have 120 seats outdoors as well. We have. It is such an exciting venture. Baha Mar, as you know, is such a gorgeous resort. And the partnership that we have with them and Grand Hyatt down there, it's going to be a really special restaurant.
From a business perspective, is it easier to set up and run a restaurant that's attached to a resort or a hotel as opposed to a standalone one?
Well, we are right on the casino floor, which is really helpful. And with, you know, the professionalism of the crew that's down there in the Bahamas at Baha Mar, it makes life much easier. It really does. I mean, there's a lot of guests who are coming through there all the time, and we're there to make them happy. Simple as that. The intention is always to make people happier on the way out the door than when they walked in.
Well, you touched on something that I've been wondering. It feels like, you know, especially with consumer spending the way it is, holding up, but still concerns there, that it feels like everything has to be experienced. People need to feel like they're getting a lot. And I wonder, you know, how prevalent that thinking is in the restaurant industry as well.
Well, I think it's imperative that we never take the guest for granted, number one. And I think, you know, I always say the degree of luxury that we're putting forth to the guest is really about the level of thoughtfulness involved. So we really want to create a thoughtful experience for every single guest that walks through. And I think that that's the payback, right? They're spending a lot of money on dinner. They're spending a lot of money to get to the resort. And the least we could do is make sure that they feel happy about it all.
Well, talk a little bit more about that and where you're seeing strength and if you're seeing any weakness when you think about the different tiers of spending that there are.
Well, you know, it's well known the challenges in the restaurant business these days, right? Labor costs are higher, food costs are higher, just the cost of getting in the door, the infrastructure costs, rent costs, all those things. One of the benefits of working with someone like the Bahamas, like Baha Mar, is that a lot of those expenses, they're already taking care of those things. So we could really just focus on the happiness of the guest. And that's really, I think, important for us.
There's been a lot of talk about, you know, sort of what people expect when they walk into a restaurant. The idea that as soon as you walk in, the first thing actually isn't what you see, it's kind of what you hear, it's the feel, it's how you greet it. Then, of course, obviously, it's the food itself. How do you balance that all out? I mean, obviously, they all have to be great, but what's the balance?
It's the mood and the atmosphere, I think, that draws people in initially. My intention was to create a restaurant with Loyola as people walk by, something about the atmosphere and the energy wants to draw them in. So even if they don't have a reservation at Loyola, the intention would be that, you know, someone looks at their spouse and says, we have to come back here for a drink afterwards. That's the warmth and the generosity that I think, particularly with Italian restaurants, you want that. You want that draw. Yeah.
I do have to ask you about your television career, and obviously a lot of people recognize you from Chopped, the cooking competition show. I think you were like one of the OGs, right?
I am.
You were kind of one of the amongst the first group of judges on that show. Why do you think that show has endured so much? Because I love it. My wife hates it. She thinks like I'm an idiot for watching it every day. But I just watched that on the loop on what it was on HBO Max now or whatever it's on. Yeah.
I think do you cook at all at home?
Yeah.
Yeah. So
not as much as my wife.
I think that there's something about being able to learn about food, having it on in the background. There's something about the competition that people love. It's a game show ultimately. Yeah. And food is the conduit for connection, I feel, and that is really an important aspect of what food television is all about.
Do you judge the contestants as hard as you would judge your own chefs in your own restaurant?
I'm worse on my own chefs, 100%. Yeah. I mean, the ingredients that we give our chefs to cook with are meant to be together. Right. Not like on Chopped where you have,
a hodgepodge.
It's a foot and an ear and you make something delicious.
In 20 minutes or 30 minutes.
Exactly.
Yeah, less puzzles to solve there. Scott, fantastic to speak with you. That, of course, is Scott Conant. Now, still ahead, we're going to talk about the business of beauty. Actress Lili Reinhart, she joins us to discuss the skincare brand she co-founded with Shelagh Wong. That conversation up next. This is Bloomberg. Skincare brand Personal Day is disrupting the beauty industry, making waves on TikTok and launching in over 700 Ulta stores. Earlier today, we got the chance to speak to co-founder and actress Lili Reinhart alongside CEO Shelagh Wong. Here's part of that conversation.
I've been very vocal about my acne experience since I stepped into the public eye, so I've been talking about it for about 10 plus years now. I started experiencing acne when I was 12, so I mean, this is a lived-in experience for me and feels very authentic and organic. And when I started filming Riverdale, I felt very alone when I was experiencing breakouts because you're surrounded by beautiful, perfect skin everywhere you go in the industry, and I felt sort of like an outsider because of my acne. So years later, I mean, when I got an opportunity to create a brand, I didn't jump on that right away because I really did not want to add to an already overcrowded market. I didn't want to just throw products out there that didn't need to be there. So, I mean, luckily it sort of came to be that the philosophy of our brand is we have products that from top to bottom do not have any acne triggers. So they're safe for people with acne prone and sensitive skin like mine, and you can use the whole line knowing that it's not going to break you out or cause any sensitivity issues. And that's because we don't have these acne triggers in our products, and that's sort of the intention behind the brand.
And Sheila, let's talk a little bit about the product line, because you think about celebrity brands and a lot of people think about makeup first, but this specifically is about skincare.
Absolutely, and I think, Lili really correctly identified a white space in the market where, there were very few products out there that were truly acne safe and very few people who even knew what that meant.
Yeah.
And so, working with our advisory board of really certified medical professionals, we were really able to clearly define what the triggers are, to continue add to that list and to make that better, and then really do the hard job of finding, folks that we can work with to formulate without, 300 plus ingredients. And, we found that the community really was very happy that we came out with this line, and we've heard that from Lili's followers.
Yeah. Last month you launched in Ulta. How important has getting shelf space in a physical location been as opposed to, just being online?
It really was huge for us because when we looked at consumers just that have been shopping from us on our D2C alone, and also Lili's community, they live everywhere. And we really, heard that they wanted to try the products, they wanted to feel the textures, and being at Ulta Beauty really enabled us to bring the products to them, to meet them where they're at. And it was important for us to be accessible. And that was really a big part of the brand.
And with our price point, like being accessible, but also when you're starting, acne is such a vulnerable experience, and when you want to try something new. It is sort of a timid, it can be timid, a lot of people are timid about that, bringing something new into their skincare routine when they have sensitive skin. So being able to go in a store, test things on the back of their hand, or try a pimple patch, or try our hypochlorous spray, like I think it can help ease people into the experience.
What's been the marketing strategy, though? I mean, you obviously had a pretty, what I thought was a pretty healthy TikTok campaign for a while. And I am curious, I know that's an attack a lot of people have taken with social media and stuff, but as you broaden it out from there, I mean, what does marketing look like?
I think it really starts with the product. I think, we're in a place, as you mentioned, that there is a lot of skepticism about celebrity-backed brands. And for us, it was really being able to go out into the market with products that disrupted every subcategory in which we played. And so when we created each product, we thought about, why does this exist? What are we bringing to the table? And, what are we hearing from Lili's vast community? And when we sort of gave them what they asked for, the community reacted, and they were, really embracing of everything we had launched. And we would watch that content and say, that's it, we've nailed it. They love it. They've noticed exactly all of the little things that we've thought about. And so the strategy really is to literally deliver what everyone is looking for.
But also in a very authentic way. I'm very, I don't want to be gimmicky, and I don't want to market something and have the product not live up to it. So the products are always first and foremost, and the efficacy of those. And then, we're not trying to fool anyone with any fancy photos or anything. Like, I wanted it to be very grounded and approachable and have the products speak for themselves.
The actress Lili, Reinhart, and cosmetics executive Shelagh Wong, they're the co-founders of Personal Day, a skincare beauty brand, if you will, clean beauty.
Yes.
If you will.
That's the pitch.
That's the pitch here. And of course, she's been making a lot of moves. Meanwhile, as we close out our coverage here on this Thursday afternoon, let's set you up for what could potentially move the market over the next 24 hours. We got a rate decision this week out of the U.S. We get one overnight out of Japan.
Yeah, looking forward to that. We also get an informal
meeting. Are you really?
I am.
Okay.
I'm going to wake up, set an alarm just for it. We also have an informal meeting of EU finance ministers and central bank chiefs in Copenhagen. I don't think I'll wake up for that one.
All right. Well, at 2:30 p.m. Eastern time, I think you'll already be awake. The Fed now gets to speak now that the Fed meeting is done. First out of the gate is going to be San Francisco Fed President Mary Daly. And just a reminder here for all of you traders out there, tomorrow, Katie Greifeld, is triple witching.
Very spooky. Should see some fireworks perhaps at the closing bell, and we'll be here to walk you through it.
All right, thanks for joining us here on The Close. We'll be back tomorrow with all of your market moving action as we keep an eye on some of the after hours movers and push ahead to politics coverage with Balance of Power.